Welcome back to the channel. We're doing another reaction today. We're going to be going over why the AI boom might be a bubble. Now, this is reminding me of the .com crash so much. If you don't know what that is, look it up. There's probably thousands of documentaries about it on YouTube, but basically, just to sum it up, the .com crash was when everyone was making a lot of .coms back in the day, buying them, selling them, a whole bunch of shenanigans, and it just burst, right? That kind of field went away, and a lot of money was lost during that time in that new age of when the internet was starting out, right? So now with AI, it's becoming a lot like this, right? And we might be seeing the big bubble that is AI with Nvidia and Meta and Tesla and all these tools and OpenAI and Perplexity and everything in pop soon. So let's see what CNBC, one of my favorites, says about this. Once again, shout outs to them. Always credit back the people that you do content on.
Global AI spending will top more than $330 billion in 2025 and $500 billion by the end of 2026. And by 2030, it could take about $2 trillion a year to support the infrastructure being built today. That's more than Amazon, Apple, Microsoft, Meta, Nvidia, and Google's parent company Alphabet made combined in revenue in 2020.
Man, look at this. Amazon is just kicking it out the park. Whew, Jeff Bezos money, man. My goodness. Microsoft is not even, that's insane. Wow, Microsoft is not even really on the map here. They're like the lowest of the low when it comes to annual revenue. It's not doing good in games, and when it comes to the AI space, that's not good.
It's the start of trillions being spent in this build out of the fourth industrial revolution. Big tech right now is doing the equivalent of building Vegas in the 1950s, where there was just sand. Dubai 30 years ago. That's what's happening with this AI infrastructure build out, from the to the data center to the grid. You're
they're
really
building a lot of data centers.
The future economy.
AI needs a lot of power and a lot of water.
But some investors are worried where this is headed.
The concerns about AI spending here harken back to the .com bubble in the late 90s. The parallel is that you're going into somewhat unproven technology and wondering if you end up with just wasted money.
At the same time, this explosion of AI spending may be masking other weaknesses in the economy. A September 2025 Deutsche Bank analysis argued that without AI-driven investment, the U.S. might already be in a recession.
GDP is being driven by all this investment. Earnings growth is being driven by all this investment
in a recession
right now, and that does create a vulnerability.
No one's acknowledging.
Still, others see AI as the next productivity boom and potentially America's best shot at growth.
Will there be bumps along the road? Yeah, but I don't fear that this is too big to fail, given it's propped up by $1 trillion on the balance sheet, generating
Nvidia's market cap tops 4.5 trillion.
So is AI infrastructure spending masking a weak economy? And what happens if that spending slows?
Sponsored by Workday.
Spending is powering corporate growth, stock market gains, and parts of the GDP. The biggest names in tech are riding a wave of AI-driven optimism.
Yeah. There's going to be more spent in the next 2 years than the last 10 years combined in tech. Yeah. 2 to 3 trillion. You're only in the second inning of a 9-inning game.
Unlike the .com boom, where companies had little revenue, many of today's AI giants are bringing in a lot of cash. But some experts are worried it may not be enough to sustain the elevated level of spending. Some companies are turning to the bond market to finance the infrastructure expansion by issuing debt that they plan to pay back later. That means if profit of the technology doesn't deliver, companies could be left with loans they can't repay. The consequences wouldn't just hit the stock market. They could also hit the overall economy.
Consumer spending, corporate spending, it all depends on how people are feeling. If people are feeling positive about the future, if CEOs look at business conditions, they're going to keep spending because the money's there. If interest rates stay low, they're going to keep spending because money's plentiful and it's easy to get. If any of those conditions should start to deteriorate, specifically inflation. If inflation starts to spike, it will change consumer attitude.
We all know what's going on, like how's it affecting us. And when I mean us, the people that's still working a career job, a 9 to 5, going out to the grocery store, buying groceries, it's affecting us and our wallets for sure. Mostly the tariffs and stuff But man, it's strange times, man. Really strange times. Like, how long could this last when it comes to the working class?
The labor
the
market
middle class is getting
removed. It will change consumer attitudes. It will change business attitudes. So all of these things have to kind of keep working in concert together to be able to continue this
it's just going to be high middle
super
class
cycle
at this point
of AI spending. Should one of them fall out of place significantly, it could change the dynamic.
NVIDIA doing a lot.
But not everyone sees this as fragile. Some think AI is simply the future of innovation.
The reality is it's an arms race, U.S. versus China. And
deep
they don't have
sink,
time because China is accelerating it as well.
Yep, it's a race,
that's
man.
Bullish in terms of the capex cycle that I really view as an AI.
The space race is the AI race now.
Experts call the spending surge we're seeing a capex supercycle. This is when companies keep pouring money into building out the infrastructure for this new technology.
Cycles, we think about an accelerated pace of something. We talk about things that we have seen in the past when huge changes come about in industry.
This is the biggest tech spending trend we've seen in the last 40, 50 years.
There's a lot of spending going on.
There's a view that it typically ends a capex cycle after 2-3 years.
And mostly a bad
this cycle means that this could go on not just for 2-3 years, 5, 7, 10 years. That's why, by definition, it's really an AI tech supercycle.
To sustain this level of spending, companies need a few things: favorable borrowing conditions, strong profits to self-fund expansion without relying entirely on debt, and confident investors so they can keep supporting high valuations and remain willing to fund long-term bets in the space.
And I'm going to pause it right there because I want to talk a little bit about that. And I feel like this is why we're seeing a lot of layoffs, right? We're seeing a lot of layoffs, mostly because of AI. I feel like AI and tariffs is the combination of the two because they want to put all their monies not only towards their stockholders, but most importantly, building up AI. Building up AI and learning about AI and integrating AI within their business and like removing those entry-level, some mid-level roles to the point where they're able to make more profits and to put more towards AI. And to the shareholders as well, because some of these companies pay dividends. If you do any type of investing, you're a part of it. Unfortunately, USA is consumers, right? It's like consume kind of thing, right? So yeah, man, this is why we're seeing all these layoffs happening. AI and tariffs.
But certainly as we go through the rest of these credible estimates of how much capital is going to be required to build out this infrastructure to avoid seeing electricity prices to continue to go up for is to require a lot of debt over time. Once that cash flow has been used up, that'll be a real sign that we're getting into the more dicey or precarious stage of that process.
If AI companies flood the market with new debt, or if interest rates stay high, investors could pull back, exposing a fragile national economy. While AI spending is booming, much of the U.S. economy isn't sharing in the gains. This spending may make the U.S. economy look healthy on the surface, but the averages may be obscuring a deeper divide.
There's this notion of a K-shaped economy that really started to take root about 5 or 6 years ago.
A K-shaped economy means that while some people, mostly investors and homeowners, are doing better than ever, others are falling behind.
One speed is people who are asset holders, like who own stocks, who own large amounts of real estate. They're doing very well. At the bottom part of that K are people who don't have exposure to those kind of things and are just living paycheck to paycheck.
That's
trying
most
to
of
save
us,
a little
man.
bit of money here and there,
It's most
not
of
getting
us.
very much return on the money.
Most people
that
don't
they
even
do
have
save,
$400
and
in
therefore,
savings,
they fall
which is
further and
wild.
further.
Consumer spending,
This is why you
which
got to
is
get out of
typically
debt
the
as soon as
cornerstone
possible
of
and start
American
investing.
economic, has been showing
Follow the Dave
mixed
Ramsey
signals.
baby steps, man.
High-income earners are the driving force behind most retail sales, but lower-income Americans are struggling to keep up.
When the spending comes from people who are at higher income levels, it masks what the greater fundamentals are for the economy. The people who have the most money, they can weather inflation, but if your income's not going up as fast as inflation is going, that's not a good thing, and it hurts more when you're at the bottom end of the ladder.
Some argue that AI could be exacerbating the divide by benefiting asset holders, while the bottom half of the economy sees little to no lift.
Own assets.
The labor market is also struggling. Unemployment is low, but hiring has slowed, and long-term joblessness hit nearly 26% in August 2025.
The labor market looks very weak to me. It's on the precipice of a more pronounced decline.
Almost all of the growth has come from government-related sectors, things that are dependent on government spending, particularly healthcare jobs and government jobs. The rest of the economy has not seen much growth as far as employment goes. So while it looks like a lot of people are working, and they certainly are, there again is another story of not a widespread dispersion of gains. Things just concentrated. And when things are concentrated, if you have weakness in a particular sector, that could spell trouble.
AI is already disrupting the job market. The International Monetary Fund estimates that about 60% of jobs in the developed world are exposed to AI, meaning they could be transformed or replaced by automation in the coming years.
Yeah, man. We recently did a video about that. Bro's getting replaced.
Yeah, net, I think it's a job creator when it's all said and done, and I think it's going to be a huge tailwind for the U.S. economy.
Estimates suggest that significant labor market disruption will scale gradually over the next decade as generative AI technology is adopted. During that transition, the divide between those who hold
probably
on labor could widen. But to some,
if they're not already, they're going to be start teaching AI in these schools, introducing that in like high school, like learning teaching with AI. Imagine, I can't imagine.
$10 multiplier across the rest of tech.
And you see how they keep on showing you NVIDIA, man. They're the top of the league right now.
And that's really the future.
Because everyone's buying their AI chips, man. It's affecting gaming too, on a side note, because we need that RAM to build those PCs. When that goes into tariffs and stuff, man, it's getting nutty, guys. It's getting nutty. Let's see what some of these comments are saying, actually. America's growth really means the growth of stock market and not actual American people. That is to the T. Not to mention the pressure AI is putting on local resources, electricity and water. Yes, and this is why there's going to be a raise in bills and water bills across the board. So this is why it's more important to be out of debt, paying off debt, and just saving money and living below your means. For sure. AI companies are all about, look how much we are spending, price goes up. It's a teen with 35 maxed out credit cards. Ooh, my heart. Claiming how much they spend is a good thing. And that's terrible. And if companies think like this, most companies do, they're going to fail. And their debt is not going to catch up with the money that's coming in as well. Dan Faves really isn't trying to oversell anything, I'm sure. Yeah, it looks like he was probably selling his business a bit. He's infamous for predicting 600 Tesla share price and $3 trillion based on billions of dollars revenues from Tesla insurance, solar flares. I believe him. Interesting. What do you guys think about this AI bubble that's going to most likely pop here? How are you going about that, and how you're spending your monies wisely in this new age of looking for work and work? That's just a reaction from me. And subscribe if you're feeling the vibe. I'll see you guys in the next video. Later.